Self-occupied property tax treatment. Let's see the computation format. First, municipal value or fair rental value, whichever is higher. With that value, we have to compare the standard rent, whichever is least. That value is called the gross annual value. Less municipal tax, because this is self-occupied. There is no question of any rent, annual rent. So straight away we will comes to the gross annual value. No expected rental value, no real rent, no annual rental value. Straight away we can come to the gross annual value. Less municipal tax paid only we have to consider here. So balance value is called annual value. Actually we see annual value is applicable only for the self-occupied property. So this term annual value is not applicable for the let-out property. Please mind it. Next, less self-business exemption. When the property self-occupied means there is two options of there. Self-occupied for their business or self-occupied for the residence. When the property self-occupied for the business means we can claim exemption under section 22. 100% of the annual value was exempted. When the property self-occupied for its residence means we can claim self-residence exemption under section 23 subsection 2. So the balance value is called net annual value. So the net annual value for the self-occupied property is always 0. Less deduction under section 24 class 1. Under this we can claim interest on loan, whether paid or outstanding. Actual interest or 2 lakh, whichever is least is allowable deduction under section 24.1. So for the self-occupied property there is a chances only for the losses from losses maximum to the extent of rupees 2 lakh. Okay, now let's see the interest workings for interest on loan. Loan taken for the purpose of either purchase or construction or repairs or any other related renewal purposes of the house property. Interest on loan for the current year means current year loan into rate of interest into period. That means in this year how many months that loan amount was utilized. Based on that, just we have to compute PNR. Loan into rate into period. Another one is pre-construction period. What is a pre-construction period? Interest on pre-construction period means interest paid or payable on the loan borrowed for the construction or related prior the period of the date of completion of construction of the property. If the construction completed during August 21, accounting year will be 21-22. Be treated as year of completion of construction. So prior the period 21-22 of 6 months be considered as a pre-construction period. So let's see. So interest on pre-construction period equal to loan as given in the problem itself. Rate of interest also as given. Period, date of borrowing to number 1, date of repayment of loan or date of completion of construction. Out of these two, which one occurs earlier? So the total interest period limited to only 60 months. That means 5 years only. Okay. Let me start practice 7. Compute tax income from house property. The particulars given below. House 1, house 2. Municipal value, fair rental value, standard rent, municipal tax and the insurance premium was given. The first house occupied for its business and the second house used for its residence. Compute taxable income from house property. Let's see the answer. Computation of taxable income. House 1, self-business. House 2, self-residence. First step, municipal value or fair rent, whichever is higher. With that value, we have to compare the standard rent, whichever is least. That value is called, straight away comes gross annual value. So for the first house, 1,25,000. For the second house, 2,50,000. Less municipal tax paid. For the first house, 14,000. For the second house, 22,500. Deduct that. Balance the annual value. For the first house, 1,11,000. For the second house, 2,27,500. The first house was occupied for self-business, so we can claim self-business exemption under section 22. 100% of the annual value was exempted. Next, self-residence exemption under section 23, subsection 2 for the self-residence property. So 100%. So the net annual value for both the properties will be nil. In this problem, municipal tax, even though it was adjusted, insurance premium only given, no information about the interest on loan, only the interest on loan, only allowed as deduction for self-occupied properties. In this problem, no interest on loan, so income from house property will be nil for both the houses. Here, insurance premium ignored. In the same pattern, the listeners can practice exercise 7. Let me see practice 8. Compute taxable income from house property of Magesh, house 1, house 2. Municipal value, fair rental value, standard rent given. Municipal tax 50% due. So 50% only paid. What's the amount paid? That only be considered while computing taxable income from house property. Insurance premium, repair charges, these and are all unwanted information. Interest on loan taken for construction, this one required. For house 1, 0. For house 2, 95,000. This amount will be allowed, permitted to deduct. Interest on mortgage will not be considered anywhere. It should be ignored. So in this problem, insurance premium, repair charges, interest on mortgage are the unwanted information. The first house occupied for its business and the second house used for its residence. Compute taxable income from house property. Let me see the answer. Computation of taxable income from house property of Mr. Magesh. House 1, self-business. House 2, self-residence. Municipal value or fair rental value, whichever is higher. I have to compare the standard rent, whichever is least. That value is called gross annual value. Less municipal tax paid, only 50% paid. Totally 14,000 for the first house and the 22,500 for the second house. So half of the amount only allowed as a deduction. So balance value is annual value. For the self-business property, we can claim exemption under section 22, 100% of annual value. For the self-residence, we can claim exemption under section 23, subsection 2. So the net annual value will be 0. But in this problem, we got interest on loan for house 2. Actual interest 95,000 or ceiling amount to 2 lakh, whichever is least, was allowed as deduction. So in this problem, for house 1, which is occupied for the owner for self-business, income is nil. For house 2, which is occupied for self-residence, he borrowed loan and also paid interest. That interest on loan will be shown as loss from house property. In the same pattern, the listeners can practice exercise 9. Now, we'll see partly occupied and partly let out properties. Partly occupied and partly let out. That means the portion of the property was divided and used for self-business or self-residence or let out. We'll see the practice 10. Mr. Ranjan owns a house property at Chennai. It has 3 equal units. Unit 1 used by him for self-residence. Unit 2 let out. Unit 3 own business. Municipal rental value 2,40,000, fair rental value 2,64,000, standard rent 2,31,000. This should be divided accordingly. Actually, this house property has 3 equal units, so we have to divide these values by 3 and we have to calculate separately for each unit. Next one, unrealized rent for 2 months. Next one, annual rent for unit 2, 84,000. Annual rent 84, that means per month 7,000. Here unrealized rent for 2 months. So out of 84,000, 14,000 is unrealized rent, balance 70,000 will be the real rent. While computing the answer, we have to do properly. Next one, repair charges. This one, unwanted information. Municipal tax, it is required. Interest on loan borrowed for purchase of property, it is also required. Insurance premium, unwanted. Let me see the answer. Computation of taxable income from house property. Unit 1, Unit 2, Unit 3. Actually, Unit 1 for self-residence, Unit 2 let out, Unit 3 self-business. Municipal rental value totally 2,40,000 by 3, 80,000 each unit. Fair rental value 2,64,000 by 3, 88,000 each, whichever is higher. With that value, we have to compare the standard rent 2,31,000 by 3, 77,000. So The 77,000 is expected rental value for all three units. Now annual rent for unit 2, 84,000. Unrealized rent 2 months, 14,000 balance, 70,000 is the real rent. So expected rental value or real rent, whichever is higher, that one is called annual rental value. If any vacancy allowance for the unit 2, we can deduct it, but in this problem, no vacancy allowance. So balance is gross annual value. 77,000 for all three units. Less municipal tax paid. Total municipal tax is 24,000 by 3, 8,000 each. So balance 69,000 is annual value for unit 1 and unit 3 only. Because unit 2 is the let out portion. We do not show annual value for the let out portion. Please mind it. No annual value for the let out portion. Only for the self residence and the self business portion only we can show here. Less self-business exemption under section 22 for the self-business property fully exempted. That means 100% of annual value. Self-residence exemption for unit 1, that is, which means that unit was occupied for self-residence. So 100% annual value exempted. So balance the net annual value for the unit 1 and unit 3 will be 0, but for unit 2, 69,000. Here we can deduct standard deduction at the rate of 30% of the net annual value. So 69,000 into 30%, 20,700. Last one, interest on loan. Actually for the whole property, 96,000 paid. So 96,000 by 3, so 32,000 each. For the self-residence, we can show here as a 32,000 as a allowable item. And for the let-out portion, unit 2, also 32,000. And for unit 3, which is used for self-business, so that interest on loan will be debited in the profit loss account as business nature expenditure. That interest will not appear under income from house property. Mind it. So the balance for the unit 1, loss from house property 32,000. For unit 2, 16,300 is income from house property. In the same pattern, the listeners can practice exercise 10. Okay. In the next video, we'll see the comprehensive problems mixed with let out and self-occupied properties for your easy clarifications. Bye.